Hi everyone, this is Haley White. My group, Team 12, and I are presenting Chapter 7, Flexible Budgets, Direct Cost Variances, and Management Control. My team includes Christina Harshman, Scott Van Denhimmel, and myself, Haley White. Our objectives include understanding the static budgets and static budget variances. We're going to examine the concept of a flexible budget and learn how to develop it. Calculate flexible budget variances and sales volume variances. Explain why standard costs are often used in variance analysis. Compute price variances and efficiency variances for direct cost categories. Understand how managers use variances, and describe benchmarking and explain its role in cost management. Static budgets and variances. I will now discuss the use of variances and how they affect a company. Management by exception focuses on areas that are not operating as expected rather than on areas that are. This can help improve overall performance of a company, not just one single operation. Managers focus on understanding the reasons for decreases. Variances also evaluate performance to motivate managers. For instance, a company may offer incentives based on production performance, which can be judged by a variance of the company. These evaluations could lead to change in strategies. Variants also help make more informed predictions about the future to improve the quality of the five-step decision-making process. Here is an example of a static budget. This is Exhibit 7.1. These production numbers of Web Company are budgeted based on the level of output planned in the beginning of the budget period. As you can see, the majority of these variances are unfavorable, which are denoted with the letter U. That means that when isolated, they have the effect of decreasing operating income compared to the budgeted amount. For example, the actual revenues were $190,000 less than the budgeted. This variance is just a level 1 analysis. The further you go, like in Exhibit 7.1, 7.2, and 7.3, they get more detailed, level 2 analysis, level 3 analysis, and so on.
Thanks, Haley. Now that we have the static budget that was set up at the start of the month, and at the end of the month the actual results, we can see that we have that variance of that is unfavorable of 93,100. What we'd like to do now is to be able to break that down a little further and try to figure out just exactly why our actual results didn't meet up with our static budget. The first step in determining this difference is setting up a flexible budget. A flexible budget calculates budgeted revenues and budgeted costs based on the actual output of the budget period. The major difference between a flexible budget and a static budget is that the static budget was prepared at the beginning of the month for the planned output. Meanwhile, a flexible budget is prepared retroactively using the actual output for the period. When calculating a flexible budget, there are 3 steps. The first is to identify the actual quantity of output. In the case of web, that's 10,000 jackets. Then you calculate the budgeted revenue. We get to this by taking the actual quantity, the 10,000 jackets, times the budgeted price of $120. That gives us $1,200,000 in budgeted sales. Next, we calculate the budgeted variable costs using the same formula as above. We would take the 10,000 jackets and multiply it times the $60 in direct materials, which would give us $600,000 in direct material costs. On Exhibit 2 on the next slide, we can look at column 3 for the remainder costs. As you can see, in our middle column 3, highlighted in green, We have our units sold, which we discussed earlier, and our revenue of 1,200,000, which was also calculated on the earlier slide. As we move further down, you can see direct materials of 600,000, which again was the 10,000 jackets times $60 of direct materials per jacket. We can also see that we get to our direct manufacturing labor, which is 10,000 jackets at $16 a jacket, and our variable manufacturing overhead, which again is 10,000 jackets times $12 a jacket, which gives us our total variable costs of 880,000. Our total contribution, which is then 320,000, and our fixed costs, which as you can see remains the same as what was in the static budget because they are unaffected by units sold. And this gives us an operating income of $44,000. Once again, it is important to note that when setting up a flexible budget, you are simply taking the actual results for units sold times the budgeted costs and revenues that were used when setting up the static budget. This gives us, once again, the flexible budget, which is our middle ground and our starting point as we start to determine the variances that will help us break down that $93,100 unfavorable variance between our actual and static budget. Now that we've set up our flexible budget, we can begin to look at variances. There are two major variances. The first is the flexible budget variance and the sales volume variance. The flexible budget variance is the difference between the actual result and the flexible budget amount. The sales volume variance is the difference between the static budget and the flexible budget. These two variances will help us to further identify what might have been some of the causes for the differences between the static and actual budget. The first variance we're going to look at is the sales volume variance. This is the difference between the static budget and the flexible budget that we just finished calculating. It's called a sales volume variance because what we are looking at is the difference between what was actually sold and what we expected to sell. In the case of web, what we expected to sell were 12,000 jackets. What we actually sold were 10,000 jackets. The difference is 2,000 jackets. With this 2,000 jackets, we are going to build our sales volume variance. The first piece is the revenue. So we will take our 2,000 jackets, multiply them times our budgeted selling price, and that gives us a total of $240,000. Now we have to determine whether that is favorable or unfavorable. In this case, it's unfavorable because the static revenue, the budgeted revenue that we were expecting, was $1.4 million compared to the flexible budget revenue of $1.2 million. So we have an unfavorable variance of $240,000. Now on the next slide, we will again look at table 7.2 and we will go through the remainder of the calculations for column 4. As you can see in exhibit 7.2, we've highlighted in gray column 4. And you can see how it sits right between the flexible budget and the static budget. And at the bottom we have a $64,000 unfavorable variance when we get done. The static budget calculated an operating revenue, operating income of $108,000. Meanwhile, the flexible budget calculated an operating revenue of $44,000. That left us with this $64,000 unfavorable variance. The sales volume variance helps us to break down just exactly where some of that $64,000 lies. We already know that we have a $240,000 unfavorable variance. That was calculated on the previous slide for our revenues. Now, because we actually sold less jackets and we're using the budgeted amounts from the static budget, this means that our variable costs are probably going to be favorable. We sold less jackets and we used the same cost numbers. So our costs are going to be lower. So let's work our way through them. So for direct materials, we have 2,000 jackets at $60 a jacket, which means our variance is $120,000. Direct manufacturing, $32,000, which is the $16 a jacket times 2,000. variable manufacturing overhead of $24,000, which is the $12 a jacket times the 2,000, and that brings us to $176,000 in differences based on variable costs. And that also brings our contribution margin down to 64,000. Now the next line, you're going to see a zero in the fixed cost. This is because the change in sales had zero effect on fixed cost. Fixed or fixed, didn't matter whether we sold the 12,000 or the 10,000, because we're using the budgeted amounts to try and to develop the sales volume variance. The budgeted amount was 276. The budgeted amount in the flexible was 276. So our difference is zero. When you add all these up, we have a favorable total variable cost of 176,000, but we have an unfavorable revenue variance of 240,000, which gives us our $64,000 unfavorable sales volume variance. The next variance we're going to look at are flexible budget variances. A flexible budget variance is the comparison of the budgeted sales price and the variable costs to the actual sales price and variable costs. This comparison is possible because we are comparing totals that were determined by the same levels of units sold, the 10,000 jackets. The flexible budget variance for revenues is the selling variance price. This is determined by the following formula. We take the actual selling price, which in this case was $125 a jacket, and we subtract the budgeted selling price, which was $120 a jacket. And we take this times the 10,000 jackets, which gives us a $50,000 favorable variance. We can use this same formula for the variable costs. This leads us to an unfavorable variance of $70,100 for the variable costs. The variance above is due to one of the following, or both. Webb either used greater quantities of inputs compared to budgeted, or Webb incurred higher prices than were anticipated. To get a little review of what we just covered with the flexible budget variance, let's look at 7-2 on the next slide. As you can see now in 7-2, we've put the flexible budget variance in between the actual results and the flexible budget, and it's the gold highlighted there in the middle. You can see our $50,000 favorable variance, which is the difference of the $5 a jacket times the 10,000 jackets. Next, under direct materials, you see a $21,600 unfavorable variance. This is the difference between the budgeted cost of $60 a jacket versus the actual cost of $62.16 a jacket. The difference is $2.16 times 10,000 jackets gives us the $21,600. And you can work your way down. We had a $3.80 variance for the direct manufacturing labor and a $1.05 variance for the variable manufacturing overhead. This led us to our $70,100 unfavorable variance. Compare that to the $50,000 favorable revenue variance that we got for selling the jackets $5 higher than what we anticipated. Our contribution margin is a $20,100 unfavorable variance. Now, as if you can remember back in sales volume variances, we showed fixed costs of zero because there was no change between the budgeted static budget for fixed costs and the flexible budget for fixed costs. But now that we're comparing the flexible budget to the actual results, you can see that there was a change in fixed costs between what we had budgeted and what actually happened. So now we have a $9,000 unfavorable variance in fixed cost. When you sum all this up, you get your $29,000 $100 unfavorable operating revenue, an unfavorable flexible budget variance. The flexible budget variance can be subdivided into two more variances to gain a better understanding of a company's direct cost inputs. These are referred to as level 3 variances. The other variances that we just recently referred to, the sales volume variance and the flexible budget variance, are referred to as level 2 variances. Our level 3 variances are a price variance, which looks at the budgeted versus the actual price of the inputs, and an efficiency variance, which looks at the budgeted versus the actual quantity of the inputs. Managers typically have more control over an efficiency variance since input used is more of an internal control and price is many times controlled by factors not under management control. In order to calculate our price and efficiency variances, we need to obtain budgeted prices and budgeted quantities, meaning what's the budgeted price for the quantity for the input that I'm about to use, and what is the amount or the quantity of that input that I'm going to use. There are three main sources for obtaining this information. Each has their pluses and minuses. The first one is actual input from past periods. The advantage to actual input from past periods is that it's real data, it's good for benchmarking against ourselves, and it's our own numbers. The disadvantage is that any inefficiencies that are built in or already taking place within our system are going to be in those numbers. So we're not really getting away from them. We're using numbers that already have inefficiencies in them. Plus, by using numbers from prior periods, we're not really looking forward in an attempt to change the number that we think we can get to. Instead, we're using a number that we've already achieved. The second is data from other companies with similar processes. The advantage is this is really good for us because we're comparing ourselves with other companies. The disadvantage is that other companies simply just sometimes are not willing to share, and this information can be very, very hard to find. And at the same time, while a company on the outside may look like they would compare to us, they may not. They just may not be comparable. Once we get their numbers and we get a look at them, they just may not be helpful. The third is to use standards that are developed by the firm themselves. The advantage to this is that we're using our past knowledge to help us build what we think should be happening, and we're also taking into account any future changes to develop a new norm, such as do we know if there's other equipment coming in, or are we getting ready to hire on new staff, which would help us to establish these new norms. The disadvantage to developing these standards ourselves might be that we accidentally come up with a standard that is unobtainable. Now, using these benchmarks that are unobtainable can sometimes be discouraging to the workforce and may have a negative effect on what we are trying to accomplish. We are now on page 258 if you're trying to follow along in the book. The first variance we're going to look at for this is the price variance. This looks at how much, and we're going to use web as our example. This looks at how much web actually paid for units used versus the budgeted price for those units used. The calculation is shown below. So for our price variance, if we look at the direct materials line, we actually paid $28 a square yard. The budgeted price was $30 a square yard. Our actual quantity of input was 22,200 yards. If we multiply this times the difference between the actual and the budgeted price of $2, we get a $44,400 favorable variance, meaning that we actually we have a price variance in our favor because we actually purchased the material $2 cheaper than what we budgeted for. Now, the price variance also looks at direct labor. If we look at our actual price, which was $22 an hour, and we look at our budgeted price, which was $20 an hour, and the actual quantity of 9,000, we come up with an unfavorable variance of $18,000. This is the $2 difference between us paying a higher price than what we had budgeted for times the actual quantity of input gives us the 18,000 unfavorable variance. Now that we have our price variances, we can take this information and go to the next step, which for web is finding out why the prices were different than budgeted. There can be any number of possible reasons, and it is up to management to determine which seems the most plausible. We have listed 4 possibilities below. For instance, did web switch to a lower price supplier? Was there an oversupply of materials in the market causing the price to drop? Was the budgeted price that they had determined simply too high? And did they negotiate a better price than what was expected? Once Webb determines what happened, they can determine if it's something that can be counted on in the future when setting budgets. For instance, did they negotiate a better price is something that was controlled by Webb. Webb's negotiating skills got them a better price. This is something that they could maybe count on in the future. Meanwhile, an oversupply of materials in the market is something that was out of Webb's control. They simply benefited from it. The efficiency variance looks at the actual quantity of the inputs used compared to the budgeted quantity, using the actual sales volume. The efficiency variance then multiplies that difference by the budget price for that input. The calculation for Webb is below. For direct materials, we have 22,200 actual quantity yards used. The budgeted quantity had been $2, 2 square yards a jacket. And using our 10,000 jackets, that would be 20,000 square yards. The budgeted price is $30 a square yard. So we take our 22,200 of what we actually used, we subtract the 20,000 that we thought we would use, and that gives us a 2,200 square yard variance, which when multiplied by the $30 a square yard gives us a $66,000 unfavorable variance, meaning that we use $66,000 more material than what we had anticipated on using. Now when you use the efficiency variance on direct labor, we take the actual 9,000 hours and we subtract from that what we budgeted for our total labor, which was 0.8 of an hour per jacket times 10,000 jackets would be 8,000 hours. The difference between 9,000 and 8,000 is 1,000 hours, and we multiply that by $20 an hour, which gives us the $20,000 unfavorable variance, meaning that we spent $20,000 more on labor than what we thought we would when we put our budget together. Just like with the price variance, now that we have our efficiency variances, we can begin to start to ask questions which hopefully we can find answers to. 4 such questions are below. Did Webb hire unskilled workers? Did Webb budget too aggressively compared to the skill level of their workers? Did Webb schedule ineffectively, which led to too much waste time? And was the equipment not properly maintained, which led to too much downtime? Once again, Webb's managers have to assess things and come up with answers, which will lead to possible changes in their budget. Exhibit 7-4, which is at the top of page 261 in the book, gives us a nice overall view of all the variances that we've looked at since we started in the chapter. Level 1 variance, which was the static budget variance. That was the difference between the static budget that we had set up at the start of the month and the actual results at the end of the month. We got an unfavorable variance of $93,100 when comparing those two budgets. Now, we were able to break them down with level 2 variances, which broke them down just a little bit further into a sales volume variance, which was determined strictly by taking the difference in the number of jackets sold. The 12,000 that we anticipated versus the 10,000 that we actually sold, the difference was 2,000 jackets, which when multiplied times all the budgeted prices gave us an unfavorable variance based strictly off sales volume of $64,000. Meanwhile, over on the left, our flexible budget variance was $29,100 unfavorable. And we were able to break that down a little bit further within level 2 to come up with a selling price variance, which was the difference between what we budgeted to sell the jacket at and what we actually sold the jacket at. And if you remember right, that difference was $5. Took that times the number of jackets sold, that gave us the $50,000 favorable variance. And then we moved on to direct materials, the $21,600 unfavorable variance, direct labor of $38,000 unfavorable, variable overhead of $10,500 unfavorable, and the fixed overhead variance of $9,000 unfavorable. As we move further into level 3 variances, we strictly looked at our variable direct inputs, our direct material input and our direct labor input. and we broke those the 21,600 from direct material variance. We broke that down just a little bit further into a price variance and an efficiency variance. If you remember right, the price variance is the difference between the price that we actually paid for the direct material. The efficiency variance is the difference between how much of the direct material we actually used. In this case, we had 44,400 favorable versus a 66,000 unfavorable. And for direct labor, once again, we also had a direct labor price variance versus a direct labor efficiency variance. And once again, that was looking at what we actually paid for our labor. If you remember right, the $22 an hour versus the $20 an hour. And our efficiency variance, which was the 9,000 labor hours versus the 8,000 labor hours. So as you can do your math, you can see how everything combines up into the different variances, and we're able to break this down and really look at how that 93,100 breaks down into all the other variances and starts really leading management to ask questions of what happened. And these questions have answers, and those answers will help us as we start to set budgets for the upcoming months ahead. The following exhibits will now show the journal entries that are a result of the price efficiency variances that were calculated for direct materials and direct labor. It should be noted that as we work ourselves through these journal entries, that all unfavorable variances are debit balances because they decrease operating income. And that being said, all favorable balances are credit balances for the exact opposite reason. They actually help us to increase our operating income. We are now going to look at the journal entry for the direct material price variance. The earliest possible time to isolate the price variance on direct materials is at the time of purchase, and that is when the entry should be made. The entry is below. First, we will take our direct materials control account and we will debit it for $666,000. That's our 22,200 square yards of material times our budgeted price of $30 per square yard. Then we will take and we will credit our direct materials price variance. And we're doing a credit because if you remember, this was a favorable variance. And we're using our 22,200 square yards times our difference in our budgeted price and our actual price of $2 per square yard, which gives us the 44,400. Then we will credit accounts payable control for $621,600, and this is the actual material purchased of 22,200 square yards times the actual price paid of $28 per square yard. The next entry we're going to look at is the entry for the efficiency variance on the direct materials. The best time to isolate the efficiency variance for direct materials is when they're actually being used, which means our entry is going to be made to work in process. And the entry is below. We are going to debit work in process for $600,000, which is the 10,000 jackets times our 2 yards per jacket that we thought we would do times our $30 per square yard that we had budgeted to pay. Our direct materials efficiency variance is the 2,200 square yards of extra material that we used over our budgeted times the $30 per square yard, which gives us the $66,000. Now remember, this is a debited balance because it was an unfavorable variance. And then you have our direct materials control, which is the actual quantity used of 22,200 times the budgeted $30 per square yard for $66,600 credit balance. Next, we will look at the journal entry for direct labor price and efficiency variance. The direct labor price and efficiency variance is isolated at the time that labor is used, which means that our entry will be made to work in process. The entry is below. We will debit work in process for $160,000. This amount is determined by the 10,000 jackets times the 8/10 of an hour that we budgeted for them times the $20 an hour that we budgeted. The direct manufacturing labor price variance is our 9,000 hours times the $2 an hour. This was the difference between how much we thought we would pay our labor, which was $20, and how much we did pay our labor, which was the 22. So that gives us an 18,000 unfavorable variance. And once again, unfavorable means a debit balance. And then the efficiency variance for our labor, which was the difference between the 9,000 and the 8,000 for our 1,000 hours times our $20 an hour, which gives us the $20,000 debited balance for the unfavorable variance. And our last entry, of course, is a credit balance to wages payable, which is for $198,000, which is the 9,000 hours that we actually worked versus the $22 an hour times the $22 an hour that we actually paid. Now let's look at the year-end entry. At the end of the year, if the variances are immaterial, they should all be gathered up and written off to cost of goods sold. Below, we have made an entry assuming that our April variances were the only ones for the entire year. And as you can see, we have debited for the direct materials variance, direct materials price variance, and we have credited for the efficiency variance for direct materials and the price variance and efficiency variance for the manufacturing labor. The net of those four numbers is the $59,600 debit balance that we're sending off to cost of goods sold. If the amount of variances are immaterial, they simply cannot be written off to cost of goods sold at year end. They need to be allocated somehow. The book mentions two possible methods. The first is to prorate the variances amongst the various control accounts such as work in process, finished goods inventory, and cost of goods sold, to name a few. The second is a combination of the write-off method mentioned in the previous slide used with immaterial amounts and the proration method mentioned above in step 1. The variances that are considered unavoidable by management would be prorated. These would include price increases that were outside of management's control, while variances that are considered avoidable, such as inefficiencies that management should have held in check, would be written off during the year. The reason for this is so that we don't want to push off into the next year costs that we felt should have been avoided within the current year. Now, Christina will take us through how management uses the variances.
Hello everyone. The first topic I'm going to present to you is management's use of variances. Variances serve as an early warning to the management team to existing problems or potential opportunities. What causes variances? Could possibly be poor design of products or processes, underskilled workers, faulty machines on the production line, incorrect assignment of labor and or machines to jobs, sales department placing too many orders at once, or suppliers not producing high quality materials. It's important to note that managers must understand the root causes of variances before making any determinations. Our text provides an example on page 264 of how Starbucks had to cope with decreased demand, along with the presence of lower cost competitors such as Dunkin' Donuts and McDonald's. Due to increased competition, Starbucks had to really deep dive into their direct costs and come up with an action plan to compete with their lower cost competitors. By analyzing and adjusting their direct costs, Starbucks was able to reduce their store operating expenses from 36% to 29%. They were able to do this by making small adjustments to their direct materials and labor. They stopped selling darker blends and decaf in the afternoon, as well as reduced the number of baristas they had on staff. Their continued focus on direct cost variances will remain critical to the company's continued future success. Now that we know what causes variances, let's discuss when to investigate them. Small variances will always occur. It's up to the management team to determine the acceptable range and or level of variance that needs to be investigated. Variance levels are often subjective judgments that are nothing more than a rule of thumb. These guidelines could be given in percentage and or dollar amounts such as $5,000 or 20% of the budgeted cost, whichever is lower. Variance analysis is subject to the same cost-benefit test as all other phases of a management control system, so companies do not want to spend time and money investigating every single variance. Now we are going to talk about using variances for performance measurement. Since managers use variance analysis to evaluate the performance of their employees, it's important to understand the attributes to which they can be measured. Two definitions we need to be familiar with are effectiveness and efficiency. Effectiveness is the degree to which a predetermined objective or target is met, such as sales and/or market share and customer satisfaction rating. Efficiency is the relative amount of inputs used to achieve a given output level. A couple of questions to consider when talking about variances and performance measurement are: how well are associates performing? Are the customers satisfied? Companies need to analyze and adjust strategies to improve performance going forward, such as the Starbucks example. It's also important to note that positive variances don't necessarily mean positive employee performance or have the best interest of the company in mind. An example of a positive variance could be that the purchasing manager bargained effectively with suppliers, thus enabling the company to procure its supplies at a very effective price. However, not all variances are a good thing and result in a net positive for the company. An example of this would be the purchasing manager got a discount for buying in bulk with fewer purchase orders. However, buying larger quantities than what are necessary for the short run often result in excessive inventory. These short run gains could be offset by higher inventory storage costs, higher inspection costs, and even defect rates. Another possibility is the purchasing manager accepted a bid from the lowest price supplier without fully checking the supplier's quality monitoring procedures. This could result in poor product, thus causing the company lost sales and unsatisfied customers. The next topic we're going to discuss is organizational learning. The goal of variance analysis is for managers to understand why variances arise, to learn, and to improve their firm's future performance. Variance analysis should not be used to play the blame game, but to help managers learn about what happened and how to perform better in the future. Employers need to find a balance between measuring the performance of employees and creating a learning opportunity within the organization. Now that we know the goal of variance analysis is to improve the firm's performance, let's talk about continuous improvement. 3 steps to follow to use variances to create an environment of continuous improvement are repeatedly identifying the causes of variances, taking corrective actions, and then evaluating the results. Improvement opportunities are often easier to identify when the company first produces a product. Companies could consider utilizing the Kaizen budget to help foster their continuous improvement environment. The Kaizen budget targets reductions in budgeted costs over successive periods. An advantage of this method is it makes continuous improvement goals explicit. Now we're going to talk about financial and non-financial performance measures. Managers use a combination of both financial and non-financial performance measures to assist in planning and control. A few of those non-financial measures are production levels and defect rates, and percent of products that require rework. Managers use these measures when it's not efficient to wait for financial reports, and also allows for a quicker resolution of issues. For example, some companies in the manufacturing industry display real-time defect rates and production levels on large LED screens throughout their plants. This allows both workers and managers to see the information in real time. This is an example of real-time performance measure. Variances will be noticed and will be addressed in a timely manner. In addition, employees and managers stay on the same page with regards to production statistics and overall department performance. The ability to keep production workers and management on the same page will ultimately only increase the overall performance of the department and the company. Continuing on the idea of continuous improvement, we're now going to talk about benchmarking and variance analysis. Benchmarking is continuous process of comparing your firm's performance levels against the best levels of performance in competing companies or in companies having similar processes. Some advantages of benchmarking are managers and management accountants know that the company will be competitive in the marketplace if it can meet or beat those standards. Benchmarking data can be purchased from consulting firms to help companies ensure that they are comparing apples to apples. An example of benchmarking is given in our text on page 268, Exhibit 7-5. This table shows the benchmarking data for United Airlines. As you can see, United uses available seat mile, or ASM, as their unit of measure. ASM is calculated by multiplying total seats in a plane times the distance the plane traveled. United has collected benchmark data from several of their competitors, not just their top 2 or 3. This will enable them to have a much better idea as to where they stand with the top airlines in the industry. You can see that starting in column B, they have organized their data into operating cost, operating revenue, income, fuel cost, labor cost, and finally total ASMs. So how well did United manage its costs? The answer depends on which specific benchmark is being used for comparison. United's actual operating cost of 14.19 cents per ASM, which is reflected in column B, is above the average operating cost of 12.91 cents per ASM of the 6 other airlines. In addition, United's operating cost per ASM is 24.2% higher than JetBlue Airways, the lowest cost competitor, at 11.42 cents per ASM. This is calculated by taking 14.19 minus 11.42 divided by 11.42. So why is United's operating cost per ASM so high, you might ask? We should reference both columns E and F, which suggests that both fuel cost and labor cost are possible reasons. According to the data in Exhibit 7-5, United needs to become more efficient in its use of both material and labor inputs to become more cost competitive.